I've been investing in China for over 25 years. And over that period of time, I've seen a dramatic shift in global investor sentiment towards China from we have to have a China strategy to China is uninvestable. Paradoxically, the risks of investing in China were lower 20 years ago when people were very enthusiastic about China. Perceptions are conditioned by your belief system, and your belief system is affected by what similar people to you believe. The word communism carries with it many negative connotations. The belief that China is a communist system makes it easy to believe that China is uninvestable. However, the success of China is because they abandoned communism as an economic system more than 40 years ago. But the government never rebranded themselves. My view is that not only is China investable, but it's risky to not invest in China. The allocation of global institutional investors to China is approximately 5%. This figure is disproportionately low relative to the role of China in the global economy. The narrative that China is uninvestable was adopted by the Western media in 2022 during the COVID pandemic. The US government, at the very least, encouraged this narrative as part of its policy to contain China. There were really two parts to this narrative. The first part is that China was bad and immoral, and that the US is good and moral. Today, it's harder to make the argument that the US occupies the moral high ground when it comes to values. Nevertheless, the belief that Chinese assets are too risky to contemplate is still widely held. So, let's look at some comparative economic and health statistics. Firstly, real incomes for ordinary Americans have stagnated for a long period of time, whereas ordinary Chinese people are enjoying a rising standard of living. Secondly, inequality is much more extreme in the US. And thirdly, the US spends at least 15 times more per capita on healthcare than China, yet life expectancy in the two countries is approximately the same. These statistics suggest that the Chinese government must be doing at least something right, and that the US might not be as great as suggested by its politicians. The US claims to have the highest standards of corporate governance. There are, however, a few holes in this argument. Firstly, the corporate playing field in the US is tilted in favor of the rich and powerful through the influence of lobbyists. Secondly, scientists generally support the propositions requested by the people who fund their research rather than being genuinely scientific. Thirdly, truth and facts are no longer attributes which are valued by the people who control and work in the media. Viewer engagement drives advertising revenues and is inversely correlated to truth. The US and China are both large, homogeneous economies. This characteristic is attractive and facilitates explosive wealth creation. If a business model is successful, then a lot of value can be created in both countries. The competitive landscape of many industries in the US is oligopolistic, whereas in China, within a single sector, competition is generally very fierce. This is one of the reasons why Chinese companies are very competitive globally. Chinese companies in key industries often charge higher prices and make higher profits in export markets than they do at home, challenging the narrative that China is always dumping their product in export markets. A high proportion of economic growth and value creation in the US in 2025 was generated by artificial intelligence. Over 2025, it became clear that the US lead in artificial intelligence was narrower than had previously been assumed. The release by DeepSeek of their large language model in early 2025 was a reassessment. It was a catalyst for reassessment. This model had similar performance characteristics, but was developed at a fraction of the cost. This challenged investors' perception of US dominance in artificial intelligence. There are two fundamental reasons why the adoption of AI may be faster in China than in the US. Firstly, inferencing costs in China are about 10% of those in the US for comparable models. This means that the adoption of AI might be faster because the cost is lower. Secondly, AI is energy intensive, and the generation of electricity is a bottleneck to the development of data centers in the US. China is the dominant player in the global supply chain for renewable sources of power. The Republican-Democrat divide over climate change science is largely irrelevant because renewable sources of energy have become economically more attractive than fossil fuel sources. The narrative that China is uninvestable implies that the risks of investing in China are intolerable, even though growth is greater and valuation multiples are lower in China. The China discount is large precisely because many investors have not yet updated their views on China. Some investors may perceive Chinese companies as very aggressive and willing to invest heavily for market share without focus on the return generated by that investment. Whilst this may be a legitimate concern for certain sectors and companies, the typical listed Chinese company generates a higher cash flow return on investment than the typical American company. My view is that China will continue to account for a higher share of global economic activity, and Chinese companies will become increasingly competitive globally. Ignoring China may accordingly not just be a portfolio diversification error, it may be a strategic omission.